Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Matador Resources Co. quarterly report. Matador Resources Company offers a diverse range of businesses and services, including oil and natural gas exploration, development and production, midstream operations to support its upstream activities, natural gas processing, services, oil transportation services, gathering services for oil, natural gas, and produced water disposal services, sales of natural gas to third-party companies. These services are provided across various regions in the United States, including Southeast New Mexico, West Texas, South Texas, and Northwest Louisiana. The decline of Matador Resources Co.'s stock price by over 20% in the past year can be attributed to several factors. A broader energy market downturn, driven by shifting oil prices and macroeconomic uncertainty, has contributed significantly to this drop. Additionally, analyst downgrades have negatively impacted investor sentiment, with 7 downgrades and only 2 upgrades within the last month. The company's third-quarter earnings report also played a role in the stock price decline. Although adjusted earnings per share exceeded expectations, revenue fell short of consensus estimates, causing an 8.77% drop to $39.93 following the release. A previous daily drop on September 29, 2025, further exacerbated the decline. These factors collectively have led to Matador Resources Co.'s stock price drop in the past year, reflecting investor concerns over revenue shortfalls and broader market uncertainty. The primary drivers of revenue growth or decline can be summarized into several key factors. Revenue growth is primarily driven by an increase in oil and natural gas revenues, resulting from higher production levels. Specifically, a 2.3% increase in oil revenues and a 34.6% surge in natural gas revenues contributed to the overall growth. Additionally, third-party midstream services revenue saw a 14.1% boost. On the other hand, revenue decline is largely attributed to decreased prices for oil and natural gas, as well as increased expenses such as depletion, depreciation and amortization, lease operating expenses, and interest expense. The decrease in weighted average oil and natural gas prices realized had a significant impact on revenues. Net income and profit margins underwent significant changes between 2024 and 2025. Initially, net income decreased by $72 million, or 26.3%, due to lower oil prices, increased capital expenditures, and regulatory matters such as climate disclosure rules and waste emissions charges. However, a closer look at the data reveals that net income actually increased by plus 151.6% from $392,056 in 2024 to $983,794 in 2025. Profit margins also saw fluctuations. While they decreased by 11.1% due to lower oil prices and regulatory matters, they surprisingly increased by plus 118.6% from 3.9% in 2024 to 8.5% in 2025. This anomaly can be attributed to the significant increase in net income, which outweighed the decrease in revenue. The reasons for these changes are multifaceted. Lower oil prices had a negative impact on net income and profit margins. However, increased capital expenditures and lower production costs helped mitigate this effect. Tariffs and trade tensions also contributed to increased costs and uncertainty, while regulatory matters added to compliance expenses. The company is indeed generating positive operating cash flow. The financial summary explicitly states this, and the data to support it is clear. For the year 2025, net cash provided by operating activities reached a significant amount of $1,950,566, indicating a substantial inflow of funds into the business. This trend continued for the 9 months ended September 30, 2025, with an identical figure of $1,950,566,000. These numbers demonstrate that the company is successfully generating cash from its core operations, which is a crucial indicator of financial health and stability. The company's financial health has taken a hit due to significant increases in its debt level and interest expenses. The total debt at September 30, 2025 stood at $2.335 billion, a substantial rise from previous levels. Correspondingly, the interest expenses have also skyrocketed, with a notable increase of $14,472 for the 3 months ended September 30, 2025, and a whopping 31% jump of $41.7 million for the 9 months ended September 30, 2025. These alarming changes indicate that the company is shouldering a heavier burden of debt, which in turn is resulting in substantial interest expenses. The company's financial performance varied across different segments. Notably, the exploration and production segment showed strong results in the Delaware Basin, demonstrating its potential for growth. Conversely, the midstream segment struggled with increased liabilities due to high capital expenditures on midstream properties, indicating a decline in performance. These contrasting trends highlight areas of strength and weakness within the company's operations. The management of the company is optimistic about its future outlook, with a focus on continued investment in oil and gas properties and midstream assets. They expect to fund capital expenditures through a combination of cash flows and external sources, with a goal of growing proved reserves and production. The primary focus for 2025 will be developing Delaware Basin assets, with capital expenditures ranging from $1.47 to $1.55 billion. Management is committed to adapting to market conditions, including evaluating opportunistic acquisitions and divestitures, and deferring capital expenditures if necessary due to declining oil or natural gas prices or increasing costs. Overall, the company's strategy emphasizes growth, investment, and flexibility in response to changing market conditions. The company has made several strategic acquisitions to expand its operations, including acquiring Ameredev Stateline II, LLC from NCAP Investments LP, purchasing producing properties, acreage, and mineral interests, acquiring midstream assets in the Delaware Basin, buying oil and natural gas properties, entering into 15-year agreements with San Mateo for gathering, compression, treating, and processing services. On the other hand, the company has also divested certain non-core assets, midstream assets, mineral and royalty interests, resulting in a $21.5 million increase in cash provided by proceeds. The company has demonstrated its commitment to returning value to shareholders through both dividend payments and share buybacks. In 2024 and 2025, the company paid out significant amounts in dividends, totaling $73.6 million and $116.8 million respectively. Additionally, the company repurchased shares under its share repurchase program, authorizing up to $400 million for this purpose. This indicates a proactive approach to managing shareholder value and rewarding investors through both cash distributions and share reduction. Concerns about inventory buildup or supply chain disruption exist. The company's financial summary highlights several concerns that may impact its operations. One of these concerns is inventory buildup, particularly with regards to lease and well equipment. The fair value measurement of this inventory when market value is lower than cost suggests potential issues. Additionally, supply chain disruptions are also a concern due to pipeline-related interruptions, shortages in NGL fractionation capacity, inflation in oilfield services costs, and tariff/trade restrictions that may limit the company's ability to procure necessary products and services. Outstanding compressor purchases as of September 30, 2025, further indicate potential inventory buildup concerns. These issues could have significant implications for the company's operations and financial performance. That concludes the financial summary for MATADOR Resources Co. Feel free to comment below, and I will be happy to answer them when possible.